Hi, I'm Josh Mahony, Chief Market Analyst at Scope Markets. This Friday, the 5th of July, brings the latest US jobs report that could bring significant volatility. And that comes because markets are expecting weakness pretty much across the board over the course of this week. They're expecting to see weak job openings data, weak unemployment claims data, or essentially stronger, so further claims or higher claims. They're expecting to see the ADP figure drop significantly, and the headline non-farm payrolls reading on Friday similarly also expected to move towards the downside. Will this come to fruition? What would it mean if we do see that? Will it force the Federal Reserve into a September rate cut? All different things that markets will be considering. But I'll take you through a number of different elements that you should be considering as we head into this US jobs report, and give you a view on where I think the likes of gold, euro dollar, and the S&P 500 could be moving around this report. So let's get things started. First and foremost, we can see that the outlook for some of this data points towards a sharp decline from that 272 reading on the payrolls figure to 160K. It's worthwhile noting this is the trading economics outlook. It's different according to each economic calendar. Essentially, if I'm looking at the Forex Factory figure, they're looking for a 196 reading. So there's a wide spectrum, but the consensus by and large appears to be a sub 200K figure. With the fact that markets have such a wide breadth of forecasts, it's quite difficult to really gauge as to whether markets have beat or underperformed a figure. For instance, if we saw a number coming in at 180, someone looking at the trading economics calendar could say, well, it's better than expected. Someone looking at a Forex Factory calendar could say it's worse than expected. So that adds a little bit of complexity to the matter. But certainly a sub 200K figure appears to be on the cards according to those estimates. Unemployment expected to remain at 4%. Average hourly earnings really a key part of it, with wage growth a key element for central banks to try and drive down. 3.6% expected from 4.1. That's a pretty hefty decline of 0.5%, with that monthly figure of 0.2 expected. If that comes in, I would say that that encourages us and encourages the Fed, that we're seeing some of the heat taken out of the US economy. Participation rate expected to tick up to 62.7. That's quite notable, actually. It's quite a decent move considering the sort of norm. Generally, we might see it move up 0.1. This one expected to move up 0.2, but nonetheless, you're unlikely to see a huge move around that. It's going to be the payrolls, the unemployment rate, and the average hourly earnings, but there's other parts to consider. So here's the breakdown in terms of where this jobs creation is coming from. I've changed some of the shades compared to the previous times that I've shown you this, and that's because I wanted to break down where we're seeing the jobs created from, whether it's the services side or the goods producing side. The goods producing side highlighted here with the warm colors. So we've got oranges and reds. And the services side, it's the greens and blues, the cool colors. The gray area, the gray shaded area highlights the government jobs being created. So what we can see here is that the vast majority of the jobs being created, certainly post-pandemic, are all within the services sector. And it's notable that when we're looking at inflation pressures, it's the services sector which has essentially all of the inflation within it. And a lot of the goods part of the economy is actually seeing disinflation. So the idea is that if we see weakness in terms of the payrolls, the key part of it is, are we seeing particular weakness in some of these services sectors? And would that drive down some of the price pressures within them? So that's a key part to be looking out for. Another key part is whether the jobs are part-time or full-time. So when we're talking about these payrolls reports or the job reports, the first thing everyone looks at is the payrolls figure. Is it better than expected? Is it worse than expected? And the initial market move is likely driven by that. You then see people moving on to what's the unemployment rate looking like? What's the average earnings rate looking like? And that's pretty much within the same realm of, you know, if we see any particularly strong moves in those, that could also spark off that initial move. But then we see people digging deeper. Where are these jobs coming from? What types of jobs are these? And the part-time versus full-time element is an absolutely key part of that. If we see a big spike in terms of payrolls, which is what we've seen recently, moves above 300K and alike, but that's only driven by a massive ramp up in part-time employment, i.e. potentially people being double counted because they're taking on a second role because prices are so high and inflation is so high. That's not necessarily a great news story for the US economy. It's a very different way of looking at it. So this is the kind of thing that could come into play as a secondary force as people start to explain away moves. So, you know, if we see an initial move off the back of a particularly sharp move for the payrolls figure, that could often be tempered somewhat when people then start saying, well, actually, that's being driven by a sharp rise in terms of, say, part-time roles, and therefore we can kind of explain it away. It's not necessarily as much of a notable move in itself. Here's a breakdown in terms of the job claims or jobless claims data. So we can see some gradual upside in terms of the initial claims and the continuing claims, in particular the initial claims. And if you're following it on a week-by-week basis, you'll say, well, we're seeing initial jobless claims ticking up in a meaningful manner. And that is a warning sign for the US economy. And like I said, there is a concern that we're expecting to see weakness in terms of well, higher jobless claims, weaker job openings, weaker ADP payrolls, weaker headline payrolls. And so it all starts to build a story about some concerns around the US jobs market. Well, as we can see here, you know, if you're putting it in comparison to the kind of moves at the back end of the COVID pandemic, you know, it pales in comparison, but it always will do. So it's quite difficult to look at it on this time frame. But by and large, I would say that the jobless claims isn't necessarily something that's going to force the hand of the Fed quite yet. We have seen this decline in terms of job openings, and that's expected to continue apace. But as things stand, whilst we have seen unemployment rate rolling over, or as you can see, bottoming out because I've inverted it to make it essentially so that you can compare it to the job openings, the black line is the unemployment rate. So it has been gradually moving higher, but we're not above that 4% mark. I wouldn't necessarily say that we've got anything too concerning as things stand, but notable that we're expecting to see an uptick in terms of the U6 or total unemployment measure, which highlights the fact that we're seeing a rise in terms of the participation rate, or certainly that's what's being speculated. In terms of the average hourly earnings, we have seen some relatively strong month-on-month figures. We're seeing it move towards the downside, but we're not necessarily seeing it back down to target quite yet. Now, I've overlaid it with the core CPI reading here, and you can see that they're generally moving to some extent in lockstep. There's a view that we're going to see a sharp decline this time around, so it certainly would move them closer to each other this time around. Of course, we're looking, as we go back to that first slide, we're looking here in terms of the average hourly earnings for that 4.1 figure to turn to 3.6. So we can see here 3.41 in terms of the core CPI. So they're moving back in lockstep with a sharp decline in terms of that average hourly earnings number. And certainly a decline to that 0.2% on a month-on-month basis would be welcoming. And we have this 3-month annualized wage growth figure at the bottom. You can see that we sort of last month ticked back up above that range that I've highlighted, that sort of zone, which is where things were pre-pandemic. So we're getting close to it. And certainly if we see that 0.2 figure, it would then take us back down towards that area and likely embolden the Fed to say, yeah, we're seeing some cooling of those wage pressures coming into play. Now, here's a couple of charts that I wanted to highlight the sort of underlying trends within the US at the moment in terms of economic data as a whole. So first and foremost, this is the Conference Board Leading Economic Index, where essentially it likes to point out potential turning points within the markets, or turning points within the US economy and potential weakness. Now, I've overlaid it with the S&P 500, and we can see at sort of times of particular concern, we see the likes of the LEI sort of rolling over as the US economy rolls over and the S&P goes with it. Well, we're seeing a little bit of concern coming into play here more recently, but we're not necessarily seeing the S&P 500 turning with it. And I guess the view is that, well, ultimately that weakness could power the S&P 500 through the perception that it could drive the Federal Reserve to take action. So we haven't necessarily seen that bottoming out of the LEI quite yet. Now, we've also got the Economic Surprise Index figure moving towards the downside. Normally, we have a decent relationship between that and the 10-year yield, but instead we've seen significant declines down into negative territory for the economic surprise figure. Not so for the 10-year yield. We have seen it drifting lower, but not to the same extent. So that divergence, we could see some sort of catch-up play at some point. But we have seen the 10-year yield moving towards the upside over the very recent term. Part of this is down to the fact that we've been seeing sort of relatively lofty expectations coming into 2024, and they haven't necessarily been matched. And so that sort of realigning of expectations. Remember, we came into this year expecting 7 rate cuts. So really, the US economy has been underperforming compared to what was expected for a year that by and large everyone thought was going to be one that was going to be dominated by economic strength. It hasn't necessarily come to fruition quite yet, as they keep having to push back those interest rate cuts. And we've got the US 10-year yield against the dollar index here, very close correlation over the course of 2023. That divergence, that's something I've been bringing up over recent videos. Actually, we're seeing a catch-up play. We've seen a sharp spike in terms of the US 10-year yield of late. Does this highlight the idea that people think that inflation pressures aren't going away and that we're going to see the Federal Reserve have to hold off for some time yet? You know, maybe, but certainly I think inflation will be a key issue going forward. In terms of the expectation for markets from the Federal Reserve, we can see July, by and large, everyone thinks we're going to see the Federal Reserve hold off. And then it comes down to September. We've got 35% chance of a rate pause. And the remaining expectations around about 65% attributed to a rate cut, potentially even a 50 basis point rate cut. And then moving in towards the back end of the year, there's an expectation we would have seen a second rate cut by that point. So with the fact that we're seeing the US 10-year moving towards the upside, is this a view that soon enough we're going to be told that we're not going to see a second rate cut? We'll see a realignment away from that second rate cut, or a pushing back of that September rate cut? Well, ultimately, we're looking here at a potential weak story in terms of the US economic data, in terms of the US jobs data. If we see weakness in this jobs data, weakness in terms of the average hourly earnings, that should embolden people to think that we will see that September rate cut and potentially drive the likes of the 10-year yield towards the downside, potentially driving weakness for the US dollar index. Or are we seeing the expectations for these weak jobs numbers providing the basis for the figures to come in stronger, and therefore we see an upside surprise and increased concern? So different ways to be looking out for this. So in terms of the charts, I wanted to bring up the price of gold first and foremost. This is gold overlaid with the US 10-year yield. And what we can see here is that generally when we're seeing the 10-year yield moving towards the upside, a potential reflation trade, or a pushing back in terms of rate cuts, we see weakness in terms of gold. And that means that essentially gold markets should do well when we see the Federal Reserve finally cutting rates and in a position to cut rates further. More recently, we've been seeing them to some extent moving in lockstep, but I wouldn't necessarily say that is the case. I mean, you could say a lot of these sort of turning points that we often see it moving in lockstep to some extent. But certainly if we were to see a sharp rise in terms of the US 10-year yield, I think we'd likely see downside in terms of the likes of gold. So if we see people fearful that we're going to have to see a pushing back in terms of the interest rate expectations or interest rate cuts, then we're likely going to see gold under pressure and a potential for the 10-year yield to move towards the upside. The caveat here is that if we get rid of this 10-year yield, you can see the trend is very much a bullish one. This is the weekly time frame. So we've been in consolidation mode essentially as we hold off and wait for that rate cut from the Federal Reserve. And certainly if we were to see a weak jobs report, if we were to see a weak payroll average hourly earnings figure, that would likely embolden people to think that, well, soon enough we will see that rate cut and potentially we could see the bulls come back into play. So this zone of support, this area of support that we've been seeing holding up, you can see on the bottom end, we're gradually creating these tentative higher lows. And so that provides an area of support down below. But for the near term, we also have this creation of, may not all line up perfectly, but lower highs as well. So we've got this sort of symmetrical triangle formation in play at the moment, and you can see price action actually rolling over as things stand. Today is Tuesday, but we haven't necessarily taken out the near-term low as we have here. So this zone of support here around about 23.18. If that holds, then we're looking for another move towards the upside. And certainly if we see weak data on Friday and in the lead up to it, remember we've got the JOLTS number, we've got the claims number, we've got the ADP number, all playing into this leading up to Friday's jobs report. If we see weakness across the board, then we could potentially see the likes of the US dollar start to come off a little bit, the likes of gold moving towards the upside and potentially coming into that deeper area. Because remember, we haven't really gone very far in terms of this rebound as it stands. We've come back up into this area of resistance that has really sort of kept much of the price action over the course of the past couple of weeks or so, maybe 2 to 3 weeks. So this 23.18 is the key level. If we break it, then we're looking for a move back down into this zone. But until that happens, the possibility of another rebound back towards the top end here, in particular, if we do see that weak data coming into play for the US jobs market. Here is the chart for euro dollar. I'm just going to show you the weekly time frame first and foremost. Here's the long term. Essentially, we've been just chopping, right? So it's a lot of sideways price action. Much nicer to trade something that looks like that, right? So that's not where we are at the moment. And this is something that looks very similar to a lot of the US dollar pairs, quite frankly. But nonetheless, if we're looking here in terms of price action of late, we're seeing euro dollar seemingly finding a little bit of a base. Now, the caveat here is that we've got the French election on the weekend. So that adds potential risk for the euro. But certainly if we were to see a weak jobs report and some concerns around the US economy, then I think it's likely we'd see weak US dollar and we'd potentially see euro dollar moving towards the upside once again. This is the daily time frame that I'm going to show you now. So we've moved towards the downside, but you can see at the top end here, we're creating these lower highs. And so there is a good chance that soon enough we could move towards the downside once again. And in particular, if we were to see inflation rearing its head once again, and it's notable that if we look at the likes of WTI, don't want to go off on too much of a tangent here, but what we've been seeing in terms of oil prices is concerning for a reflation trade, right? So if we see a resurgence in terms of inflation, that's not good news. So we're going to be tracking that because oil prices push gasoline prices higher, push month-on-month headline CPI higher, and that provides risk for the likes of stock markets, but potential upside for the US dollar. So for the near term, if we see weakness in terms of the jobs market, it could provide weakness for the US dollar and a potential pop here for euro dollar. As we can see here, potential sort of basing taking shape here with the sort of top end now trading like that and then potentially moving like that. So we do have the possibility of near-term downside. We need to see a breakdown back below the near-term swing low that we have established down here at 106.6 to look to continue the recent bearish trajectory. Until then, I wouldn't be surprised to see a little bit of an uptick this week as we see the possibility of some weak data out of the US and people feeling a little bit more emboldened for that September rate cut and the 2 rate cuts this year that markets are currently pricing. And then finally, looking at the S&P 500, here's the daily time frame. Ultimately, this market goes up and up and up, right? So we don't necessarily want to stand in the way of a train, but nonetheless, there is risk inbuilt if we were to see some strong inflation data, if we were to see some strong jobs data. But the flip side of that is if we see some weak jobs data numbers over the course of this week, and we again feel emboldened by this idea that we're going to see rate cuts coming in the near future, it adds more fuel to the fire for this market. And certainly you're talking about a market that keeps increasing. Now we've got the US second quarter earnings season coming up soon. So that's another area for this market to be driven by. But when it comes to the time being, of course, there's that focus still on the economic data, on central banks, and therefore this should be a really interesting one. So 5446, that's your near-term swing low. We've come into it and tagged it just sort of on Monday. The view here, I think, is if we break below that level, there's a possibility of us rolling over into a near-term retracement. But even if we saw that, we'd be looking at a retracement rather than a sort of all-out sell-off in a meaningful manner. But nonetheless, I think there's a good chance that we do, as we move throughout the week, if we see that weak job story coming into play, it weakens the expectations for inflation. It puts pressure on the Federal Reserve to feel like they need to act because they think that the jobs market's rolling over, and it emboldens bulls within the S&P 500. So this market is a long-term, benefactor for the bulls. I wouldn't necessarily want to stand in the way of that. And certainly as long as we continue to establish those intraday higher highs and higher lows, it points towards the possibility of the bulls remaining in charge for the S&P 500. I hope that's been useful. We'll continue to provide you breakdowns on different events, whether it's political, whether it's economic, previews for earnings season. We'll have to kickstart those again soon enough, because the second quarter is coming up, and then those weekly look aheads that we have, also taking a view on what the big ticket items will be for the week ahead. So plenty to follow. Make sure to like and subscribe to the channel. Thanks for watching. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.